My name is John Marshall. I'm a financial analyst working with UFCW local seeking to oppose this merger. And what I want to do for the next few minutes is really sort of cover a couple of key points, and then I'd be happy at the end of the call to try and answer some questions. The first main point I want to make is that despite some recent claims to the contrary, C&S Wholesale Grocers has a very well documented history of eliminating thousands of union jobs. Secondly, I want to make it clear the overwhelming majority of C&S's revenue today comes from its wholesale business. Retail operations make up a very small minority of its revenue. The challenges for wholesalers to successfully operate retail stores is very well understood in this industry. Lots of other wholesalers have tried it and failed, and we are very concerned about C&S's capacity to effectively operate a significant chain of retail operations. In the past, what we've seen is C&S has acquired retail stores only to sell off some of them to other retailers after establishing long-term supply agreements with those retail stores. So really thinking like a wholesaler, not like a retailer. Importantly, I want to emphasize that this proposed transactions has very concerning echoes of the disastrous 2015 Albertsons Safeway divestitures to Hagen, which Monique just spoke so eloquently about. In particular, the very low sale price that's been proposed by Kroger raises serious questions about the quality of the divested stores and about the incentives that C&S will have to operate them or potentially monetize them in some other way down the road. Let me start with C&S's anti-union record. If you look at the company's history with workers, the primary union that has been engaged with C&S is the Teamsters Union that represents workers today, about 1,000 workers in C&S warehouses. Over the decades, there have been numerous fights. This graphic here on the left side of the slide is the cover of an economic impact report the Teamsters Union collaborated on with local elected officials in New Jersey around the closure in 2011 of a warehouse in New Jersey that would cost 1,300 jobs. Local elected officials came together and called on C&S to stop the closure. C&S closed the facility anyway. In another fight several years later in 2015, over a 700 worker facility in Maryland, at that point, the Teamsters had estimated that they had lost 4,500 jobs from C&S's union busting. Recently, in 2022, C&S won a $58 million ERISA withdrawal liability suit that was filed by the New York State Teamsters Pension Fund. What's really critical to understand about this particular case is that it resulted from a previous acquisition that C&S made of a unionized company, and they structured the agreement in such a way as to limit their own exposure to existing pension liabilities, something we are very concerned with today as Kroger proposes this new transaction. Currently, there is a UFCW Local 1 in New York, which represents workers at 12 top stores, or formerly top stores, now bannered as Grand Union stores, that are owned by C&S. C&S just acquired them in 2021. Local 1 of the UFCW attempted to negotiate severance agreements with C&S, but was unable to do so. This is a quote from Local 1. They attempted to negotiate those severance agreements. All they could get from C&S was a commitment that they would not sell or close those stores for 18 months, just 18 months. What's also notable about that commitment, so-called, is that C&S had already been required to commit to the Federal Trade Commission they would not sell those stores for a period of 3 years. So what they were willing to give to the union was only half what they committed to the federal government. I want to shift gears and talk about the 2015 Hagen bankruptcy, because it's been discussed quite a bit, and I think there's some important elements we need to really emphasize. Hagen was an 18-store regional chain based in the Pacific Northwest. It was owned by a private equity firm called Comvest. It was acquiring 146 stores from Safeway Albertsons as part of that divestiture remedy in 2015. They went from 18 stores to 164 stores, an eightfold expansion. And obviously, they were not able to effectively operate those new stores in multiple new states. It was the fastest bankruptcy in history. In less than 6 months, they were filing for bankruptcy. Now, this was not some foolish gamble by Comvest and Hagen. They understood very well, we now understand from the court documents, that they were taking on significant execution risk by expanding so dramatically in so many new geographies. But they did it anyway because they realized the transaction was, quote, too juicy to pass up because the real estate value was greater than the purchase price they were being asked to pay. And then the partners in private equity firm Comvest structured the transaction so the real estate assets would be separated from the operating company and the risk that those stores would go bankrupt. And that's exactly what happened. There's been a lot of questions raised today. People have said, oh, well, CNS has deeper pockets than Hagen did. That's not the issue. The issue is that Hagen and Comvest deliberately separated the capital of the stores from the operations of the stores themselves. And that's what we're concerned about today. So let's take a look at the proposed transaction here today. We have a company, CNS Wholesale Grocers, not based in the Pacific Northwest, this time based in New England. Limited retail operations. They claim 160 stores. We believe they only have 55 stores at most that they own and operate. That would be not an eightfold increase, a 7.5 times expansion into multiple new geographies where they currently have no retail operations. Aside from the specifics of this situation, as I said, if you look at UNFI, if you look at SuperValue, if you look at Spartan Nash, wholesalers have a terrible track record in this business as retailers. There's a history at CNS of closing and selling stores after acquiring them. Specifically, with regard to this divestiture, I'm going to wrap up quickly because I know I'm running low on time. The purchase price of $1.9 billion that's been disclosed. First of all, very little has been disclosed about this proposed transaction, but we know the purchase price, $1.9 billion for 413 stores, 8 distribution centers, 3 banners, and 5 private label brands. We believe that the assets are very likely worth much more than the purchase price. The distribution centers alone, we believe, are at a minimum worth $400 million, easily over $800 million. The store real estate alone, we estimate, is potentially worth $2 to $3 billion by itself. Now, what assets are not included? Customer data. This is a critical missing piece that you would need to successfully operate these retail stores. In 2015, customers went to the stores that were acquired by Hagen with their Safeway and Albertsons loyalty cards. Those cards didn't work. They didn't have the new customer data. Today, not in 2015, 2023, customer data is so much more important. How do we know that that CNS will be able to keep those customers without having the data? Why didn't they demand to get the data? We want to know this. We know very little about how the deal is being structured. We know that the assets will be not acquired by CNS itself, but by a new affiliate, 1918 Winter Street Partners. There have to be other co-investors. They have not named them. There have been some media reports about SoftBank potentially financing the deal. Is SoftBank a partner? We want to know who is acquiring these assets and what their long-term motivation is. Fundamentally, the question is, because there's so much value that CNS can derive without ever earning a dollar of profit from operating stores successfully, how are they going to be incentivized to do that? Do they simply want to monetize this asset?